Hey guys, welcome back to the channel. Today I wanted to go over a topic that I've been thinking more about lately. I know that I've mentioned that there are basically two assets that you can think about when you're investing, bonds and stocks, but there's actually kind of a third asset that doesn't exactly fall into either category, though they're traded sort of in the same way. And that's, sort of like commodities or hard assets. And so these sorts of assets are things that don't necessarily have companies behind them. You're not like investing in anyone who's sort of trying to make a profit. And they're not like promissory notes the way bonds are. Instead, you're investing in certain specific assets that people want to buy, right? So like gold, silver, even things like corn, real estate. So things that increase in value over time, but don't necessarily generate revenue in the same way that a company would. It's another place that you can think about investing during other times of volatility. And so why do you want to invest in these assets? I would say first off, there's a lower correlation or a negative correlation between these assets and the US equity markets or other equity markets. So that just brings you more diversification across your portfolio. When you have assets that are extremely correlated to each other, when one goes down, both are going to go down, right? And if one goes up, both go up. So it's just a time. So when you own assets that are of different correlations, when one goes down, the other might not go down by as much, or it might even go up. And so in those instances, it gives you a chance to sort of rebalance your portfolio. On top of that, a lot of these assets help to protect you against inflation. So we know that as we witnessed sort of over the last couple of years, inflation has really taken a toll on sort of our spending ability. But these are assets that sort of over the historical periods have grown with inflation. So they keep up with inflation. Whereas not everything does keep up with inflation, right? So if you were to hold your money in cash, obviously that won't keep up with inflation. Similarly with bonds, yes, it's paying you a fixed income, but you're not going to keep up with the rising costs of goods. And the equity markets, again, they can move with inflation, but a lot of times they can also get hit because of inflation, because obviously companies need raw inputs to make their products, so they also are hit by inflation. Secondly, it's just whenever inflation happens, it's a good place to go. Investors will flock to those assets. Thirdly, it's kind of just a store of value during any sort of volatility or a crisis period. So when people are just very scared, they tend to retreat to sort of these hard assets. And so it's really just sort of an insurance policy. If the markets pull back, if people get really scared, these tend to keep their value or go up. You can see that anytime there's sort of volatility in the markets or people are fearful, there's a tendency just to go into hard assets like gold and silver because they're just seen as the store of value. And finally, they just will perform differently in different markets. So they can be a tactical or short-term strategic position in your portfolio. So if you just feel like, based on data, that we are going to see inflation come, we might want to allocate some amount of our portfolio to these hard assets that move with inflation. Or if we see a downturn in the market and we think people are going to be scared, we might want to do that as well. So those are sort of the reasons why you might include them. I'll say up front, you don't want too much in these assets, right? Like the main drivers of your portfolio are still going to be equities. And so for the long haul, those are companies that are generating revenue, that are generating profit, that continue to grow. And so there's real value behind them. And with hard assets, yes, there's a stored value to them, but there's sort of no growth inherent to them, except for as much as people want to buy them. A couple of the key asset classes we'll go over, precious metals, so that's gold and silver, energy and industrial commodities, so that's anything from like gold to copper to, just like broad baskets of industrial commodities. There's agriculture, which, can be just like corn, wheat, anything that's sort of grown. There's REITs, which, you can also invest in private real estate as well, but REITs are the most accessible for the average investor. And that's just buying real estate that generates, monthly income. And then there's sort of like infrastructure ETFs. So that's, roads, power grids, all the inputs and building of that stuff. So, these are sort of like the key places to invest if you're looking at allocating a small portion of your portfolio to these kind of like hard assets or commodities. So, precious metals, we can start by just going over, a few of the major precious metals ETFs. Again, you can invest in all sorts of precious metals, and it's sort of, some of them are more useful utilitarian products that are actually used in a lot of like actual engineering, and they're used in products. You can talk about precious metals, and some of them are simply really just, you buy them because they're seen as a storage of value. Again, gold is especially like a place where a lot of people invest their money as a storage of assets. And so GLD and IAU are two gold ETFs. Again, these are investing in bullion, so they're investing in actual gold bars. And instead of, you can also invest in people who are mining gold, companies that mine gold. And in this case, you want to actually purchase real gold. So you're not holding it yourself, but a bank holds the gold for the ETF that you buy. And similarly, there's silver ETFs. Two of the major ones are SLV and SIVR. So silver and gold sort of move in tandem with each other, but there are certain ratios that tend to signal when one is sort of more undervalued than the other. And right now we're sort of in a place where silver is a better deal. I've heard that, anything for the gold to silver ratio, anything above like 80 is really good to buy silver, and anything below 20 is really good to buy gold. So, we're in like a place where it's still fairly good to buy silver at the moment. Next up, a couple, energy and industrial commodities we can talk about. So oil, there's a ETF that's USO, copper is JJC. There are a couple broad basket ones, DBC and GSG. Again, these are, investing in energy inputs. So they're sort of, again, assets that companies will use, that basically all companies need, because, a lot of these are the most raw inputs of anything. So again, sort of anytime anything is happening, they're in use. So it's a sort of fundamental product. Similarly, I'll go quickly over agriculture. There's actually one ETF that invests in corn, and it's literally CORN. There's wheat, which is WEAT. And so there's a sort of broader basket of agricultural goods, DBA. So these are, again, if you're looking for sort of, again, the most raw inputs, this happens to be in the agriculture space, but it will be protective during periods of inflation, and also periods where, people are sort of scared. Next up is REITs. Again, I've always considered REITs to be, not a driver of growth, but regular income. It will sort of grow over time with the real estate market, but it will also just provide you some regular income from, lease payments that they receive from their either commercial or residential properties. And the Vanguard one I always go with is VNQ, but there's a Schwab one that's SCHH. And REITs are one of the places where, you can also invest in direct companies, because they give, monthly payments. And if that's something that you're looking for, there are a couple REITs that I've sort of listed before that are fairly good and give you that regular income. Finally, there's infrastructure ETFs. Two of them are PAVE and IGF. And again, these are the most fundamental sort of assets that we're thinking of. So again, a lot of the unifying thing among all of these assets is that they're sort of the very first inputs along the way. They're most sort of like consumer staples of all things. We'll always need roads. We'll always need power. And so a lot of these things are the things that even get us to those raw inputs. So, what do you think about when you're allocating some portion of your portfolio to these hard assets? Really, they shouldn't be like a huge portion of your portfolio. Generally, I've heard, around 5% is where you want to be, but anywhere from like 3 to 10% is probably fine, depending on sort of where you are tactically or strategically with them. But, make sure not to keep too much of your portfolio on them. Again, they're a hedge against inflation, against volatility, against fear. So when, we're sort of like in those times, they really are helpful. But like outside of that, you're going to see a drag to your portfolio. So don't spend too much of your money on these things, but having like some portion of them could really help you in times when the markets are stagnant or having negative returns. You want to be strategic about them. Don't just, buy a ton of them because you feel like you want to have them as you're hearing more about them. Think about like where we are in the cycle, the market cycle, and think like, oh, do we intend to see some sort of economic contraction? Do we think that inflation will continue to go up? And in that way, you can sort of like maybe set your target at 5% and then build it up slightly higher during strategic times, maybe up to 8 to 10%, or bring it down if you think that like inflation isn't happening. You can bring it down to 3% or lower. It's just make sure you keep rebalancing throughout it. Like as you invest, you'll see that like if equity markets are on a tear, it's just gonna become a larger portion of your portfolio. So then you trim back and you try to reallocate to different places. Same holds true for your commodities. If you have set your target at 5% and it drifts to 12%, you probably should pull back down to 5%. So in general, it's not just about the returns on these assets. Really, what it's about is about creating more stability in your portfolio, giving you some flexibility to rebalance to different targets, diversifying your portfolio. I think that having a few different types of assets and reducing correlation among those assets just helps give you a bit of control over different markets without having to sort of play stock picker or deciding what's going to be, what the market is going to do. You're betting on the entire market. It's just as certain assets grow or perform better than other assets, you can pull back on those assets and reallocate them to underperforming assets, and that just helps keeps you disciplined in your investing strategy. So part of this is also just about setting your target allocations and sticking to them, and not trying to follow the latest trend. So while I am talking about this because I think at the moment having some commodities does help your portfolio, really you should think about this as a long-term strategy, because you'll always have them in your portfolio just in case. So yeah, I hope this was helpful just in introducing commodities and other hard assets to your portfolio.